just come to my realization that I might have been unfair to the neophytes over here. What am I speaking about? That's my 3. Okay, this was my 3 in there. Coming up in here. Never mind. You know what I mean. This was my 3. Then this was my 1. Price retraced all the way back up to the top. And I said, if this happens, dude, that's the best day ever for you. Sell and hold. Right? Because price is premium again. If you take Fibonacci from here to here, around about here, it's 50% Fibonacci. The algorithm treats this as fair valuation. The market maker's fair valuation, which is simply 50% Fibonacci. Beneath here, it's discount. Above there, it's premium. So when price does that, it's in the premium, buddy. That's why you're good to sell again. Not looking for breakouts and retests and all that crap. And yes, I know for some of you, you can argue this. But Sikude, it looked like a consolidation, stop and low. What's the context? Why are you looking for consolidation, stop and low after an M? After an M, you're looking for an A. Okay, so I'm not going to beat you up for buying in here or something, so long as you close that profit. So long as you close that profit, I'm not going to beat you up for that. But for me, on this day, on this particular day, and I traded this, I remember, I was looking for sells. The telling language are the gaps and the pins, the gap between those candles, the gap between those candles and the pins closing to the upside. A lot of up close pins. Jeez, man. Pins, hammers, indecision, bear harami, whatever you want to call it. Let me remove the lipstick. The pattern thereafter after an M is an A. Between the M and the A, it's level 1 because it's replacing this structure in here. The level 3 structure, therefore it's level 1 reverse. Then you get your level 2. Right? I'm going to put the annotation right here, and then you get your level 3 down in here. Let me just use the same arrow. Between A and W, you get your level 3. If this is my level 3 in here, I'm making this very precise for one reason. If this is my level 3 in here and it started here, started right there and then went all the way down here, if that's my level 3, then from down here all the way back up there, it's level 1. We get a predefined consolidation at the end of the day. I know people are going to argue, but you said you like taking the real bodies of the candles. Yes, I know what I said. So we got a consolidation now. Price moves back into a consolidation. And it stays within the range. Smaller consolidation gets delivered back into the bigger range, moves back into a small consolidation, gets back delivered into a bigger range, so they swing high and they swing low. In this case, they swing low and they swing high. What this does is it accumulates traders, in the sense sellers and buyers. Why am I putting buyers and sellers on the worst end of the range? That's because that's how retail traders think. They think breakouts. Oh, it broke out and did a retest. Oh no, it's doing the ABC pattern. There's no ABC pattern here, buddy. It's just the same thing over and over again. And in this case, on this particular day, this is what we're looking for. Price comes out of a consolidation, gives us a W. You're looking for your V, and then your M. Where do you anticipate the M? Around yesterday's high of the day. Where do you anticipate the M? Around today's high of the day. But how do you identify the high of the day? In this case, price comes away from the low, the W, the low. The M is on the other end of the range. It is the high up in here. So essentially, O, L, H goes back into consolidation. Then you get your C, your close. You don't believe me? Let me show it to you right now. Moves back into consolidation. In this case though, there is a variation on a theme. You remember that I made the point that this is just level 1 and here. Exactly, so this is our level 2, and in this case, variation on the theme, the level 2 takes out the buy side liquidity. Alright, I'm not going to speak about order blocks and all that stuff, but then the next part of this actually relies on that. Don't worry, there we go. It's not an order block, it's in now. Let us speak about this in detail, okay? But this is my V, so if this is my level 2 in here, the consolidation structure in here is my second V, so my anticipation is the letter M. How do I actually go into all of this? Alright, so on this day I got my W formation after the consolidation, the stop and low. Okay, then I got the rise. Then after I got the rise, which hit the high, the previous high of the day, I have a tool also for this. Paints the previous highs and lows, previous daily high. That's how it would annotate on the screen. I think it's a blue tracer or something like that. The color of it would look something like this, more or less. Let me check. Yeah, it looks like this. Alright, so on this one, the blue tracer would have looked something like this. Previous daily low. So essentially, liquidity rests above or below the previous daily high, previous daily low. In this case, this would have been the daily low. It doesn't take the full body like how I do. I'm just the one who's picky, and I take the bodies of the candles. The bodies of the candles. The bodies of the candles. Rather than trusting the wicks. Yes, I do trust the wicks on the smaller time frames as a side statements. But for what I'm doing here on this time frame, that's just all I'm looking for. So here, this is the daily low now. And in this case, I think it's usually purple, like low of the day. And this doesn't only become, but it also becomes, when it gets to this day, the Monday, this becomes the previous daily high. I think this might have also been the low of the day for this one, but then I'm not going to be focusing on this one. I'm just going to be taking this one, all right, for the purpose of this trading day and the sense of understanding liquidity. They're going to take the most recent low and high. So that's how the algorithm treats price, essentially. Because okay, I wasn't supposed to do that. No. Yeah. Okay, that's chill. So you get that consolidation period, stop hunt low, price rises, creates the high of the day, and then it moves away from the high of the day, moves back into a consolidation to start the next trading day. As the period separates in that case. Alright, to begin the next day, price is contextually traded. Right? So I'm just going to consider this as a consolidation in my analogy. By the way, I'm moving really slow because that's what I recommend for you to do. There is no need for a rush. There is absolutely no need for a rush. By the way, on this day, what's the counts? The counts would have been those 3 candles, starting with that one that breaks and closes beneath that low there. So it's 1, 2 candles on this one, 2 big candles, spiking candle. This in fact is a liquidity void. That's why price comes back and trades back into it this way. Then price leaves a fair value gap. So I want to discuss entries before I move on to that day. Creates a fair value gap on the minute 15 here. This is a good second leg entry for this W formation. Ended on a hammer, two hammers really, on the fair value gap in the minute 15 time frame. Otherwise, where is the best place to buy on this one? It's down here on the daily low. You're not going to deal at the absolute low, of course, but what you can do is you can enter in here while it's going down, and as it pushes down, that's a gamble though, as it pushes down, you martingale on the trade, which is ill advised, by the way. However, with what I've achieved in the previous 3 months doing that, I think it has increased my hit rate. But I know that this is going to be happening, so that's why I'm so confident in taking those trades. Again, what's the thing that would have made me confident for taking that trade? Because it didn't necessarily go down to the previous daily low. You see that big candle there? On a smaller time frame, this is a swing high. So this entire thing is that animal from before, the one I called an imbalance. And in this case here, it's painted upside down on the box. No problem though. So it's an imbalance. This entire area is an imbalance, and price trades from imbalance into inefficiency. Where was the inefficiency in this case? The inefficiency resided within that structure up in there. Right? I wouldn't really like to say that because the structure that I'm referring to is actually more rightwards on the smaller time frame. But then that's a story for another day. As I said, I don't want to involve this Otherwise, I'm going to go off topic. So, price goes into a consolidation. We get the open on Sunday. Yes, I am fighting against mosquitoes. Yeah, I get that open on Sunday, and price goes into a frenzy. Premium goes back into premium again. This is my V1, this is my V2. So the anticipation is the M. How do I then anticipate the M further? I'm going to get 3 individual pushes from this low here, and I get them. Let me just remove that moment. 1, 2, and then I get 3. And on that 3, I get that lovely individual 3 pushes called vector candles. If I were to open a smaller time frame, I would be able to identify that this is a consolidation in here. Something like minute 5 or something, or minute 1. But on TradingView, I'm aware that you're able to go on to like minute 3, minute 2, minute 1, whatever Fugazi they have there. And this introduces the very much famous railroad track candles. I know in the past I had...
The time is 22 o'clock.
Well, it's 10 o'clock. I've been going for an hour. Okay. Railroad track candlestick pattern, and the second leg closes as an evening star. You can enter there. Okay, forgot to actually annotate on these ones as well. You can buy in here. By the way, it's also safe to buy in here, but the entry candle is too big. If you were going to be using a stop loss, your stop loss goes here. So that's quite a big one, but then it's good. On a smaller time frame, there must be a fair value gap in here for you to enter. Okay, silver bullet trade, ICC traders. So yeah, you can go long in there because you anticipated that this is the W coming from that M. So M-A-A-W. You can also just put strokes on like this, so you know what, like you've been counting 1, 2, 3. All right. Then now you know that this is 1, and that's 2. Definitely that's 3. Okay. Yes, I love it too. Okay, so now we get our information. This is the first leg, and this is the second leg. Leg, L-E-G, L-E-G. Okay. Your entries are on the second leg short. Yes, you can also take entries short in here. There's that imbalance I spoke about the previous day, but then we're reading price this way. So if that's my M, then price moves away from the high and goes back into a consolidation to end the day. Hallelujah. Yeah, actually. Consolidations. Actually, no. Consolidation. So, in this consolidation frenzy, the market maker manipulates price in such a way that the majority of the traders who are trading long and short do not make a profit. Now, I left these blue traces here for one particular reason. I need you to identify that the market maker trapped at a certain price point on Friday and doesn't look back Saturday, Sunday, Monday, Tuesday. I don't know if you get it, bro. But if you were trading that and you're taking it long in here or long in there, thinking this in your silly brain. No, that's the breakout and the retest. The lightning bolt is gonna hit you in the head. That's what my mentor used to say, Steve Morrow. Okay. That's BS, buddy. It is absolute BS. This pattern that I'm giving to you right now outweighs any man-made indicators. Alright, so they gap away from the number all the way to the close, pushes straight down. So if that's my M, this entire consolidation structure is my A. Guess what? There's going to be another period of consolidation. Wait for it. Come on, see. There it is. And this consolidation, timing wise, let me go back to the timings. This move came in London time, went back into consolidation all the way through the US session, then it dropped further down into the Asian session, and in the Asian hours it went back into the Tokyo channel. Alright, so that's why the first task for you as a neophyte, if there are any in here currently, was to mark out consolidation. It's because that's the instance of market condition. That's like the initializing move of the market condition. If you can identify consolidation, you can sure enough 8 times out of 10, 9 times out of 10 be able to identify the stop hunts. When you're able to identify the stop hunts, 9 times out of 10, you're going to be able to identify your entries. You're going to be able to identify your exits. I know it to be true that I got in here and I sold. The only reason why I got in there is because I knew the pattern. I knew that the market maker's algorithm, for some strange reason, could be targeting either one of these numbers. By the way, I watch the charts naked like this now. I used to watch it with exponential moving averages and Traders Dynamic Index. I don't anymore. I don't even need those tick volumes at the bottom. I just put them there for interest sakes. Guess what? The volumes are the same thing each and every day. 24/7, 365. Let me help this guy out. He fell asleep on the couch and the mosquitoes are doing him bad.